everyone. Welcome to this episode of Mayhem in the Markets, brought to you Sunday, April 9th, 2023, by macrovisor.com, where we make macro accessible and actionable for everyone. On screen, we have a significant decline in multi-family building sales, which is likely to hurt construction on top of the slowdown we're seeing in commercial construction and commercial real estate as a whole, where commercial mortgage-backed securities have almost completely locked up, and where most of the biggest lending for commercials and industrials comes from these small to mid-sized regional banks, that many of which are struggling and a lot are pulling back on credit. And we'll look a little bit more on that soon. But this chart here suggests that there are opportunities because of this macro environment that are going to lead to single stock industry sector shorts, commodity shorts, and otherwise. This is something that will also present longer term opportunities to the upside when we see that re-rating of risk finish, that process of basically multiple compression to account for a slower economic environment. Next, we have credit conditions are tightening again, particularly for small firms. Now, this chart is showing us that consumers have experienced a tightening in credit conditions with some degree of relief, but small firms and really large firms as well, but large firms tend to have more resources available to them to get credit. But we see these lending standards tightening really across the board. And what does that tell us? It tells us that there's going to be more and more slowing in the economy, in demand, in hiring. We're going to have more probability of businesses shuttering operations or even closing altogether. This is something that leads to higher unemployment as well. So it's often that when there's a big tightening in credit conditions, because we are in a debt-driven economy, you do see slowing in the economy and ultimately a recession. I don't suspect this time will be different. I also don't think the tightening of credit conditions is anywhere close to over. Remember, for small and medium-sized firms, they often have to take these revolving lines of credit if they can qualify for them. That puts them at the mercy of the interest rate environment, which has been rather unforgiving for the last year. So a lot of these small firms, if they're able to get credit, they're paying a lot more for it as well. And this is important because small businesses are the engine of employment growth in this country. If they're not doing well, the economy as a whole tends not to do well. So we should be keeping an eye on these credit tightening signs that are happening all around the economy. This is something that Powell has spoken publicly about, sort of doing some of the Fed's work for them. It's also something that we've heard from various banks that they're going to start to be a little bit more conservative because they don't want to get on the wrong side of a loss of customer confidence. There doesn't have to be anything particularly wrong with the bank, but because there's generally some degree of duration mismatch between assets and liabilities, or basically between the bank's lending book and what it's bought to generate income versus the deposits that they owe, that can get into a situation where even if the bank is okay, it can still have pressure that leads to undesirable outcomes, right? If they can't raise enough capital from their less liquid securities to meet the demands of a rush of people wanting their deposits, you can have that bank fail or at least have problems that, can lead to a loss of confidence that ultimately lead to its failure or buy under or some other type of event. And bank lending has dropped dramatically. It fell by a record $104.7 billion in the last 2 weeks of March. So the idea that the Fed opening the discount window and the super discount window and how that's going to be Q eternity part 6 or 7 or whatever it might be, the reality is a lot different here. And that is that we are seeing liquidity coming out of the system. We're seeing bank credit tighten. We're seeing less lending into the economy. And we're seeing the Treasury general account shrink. We're seeing QE begin to shrink the balance sheet, QT begin to shrink the balance sheet of the Fed again. And this is something that all leads down the same path of economic slowing, where growth is slowing, where there is greater potential for a recession, where businesses, consumers, and especially state and local governments don't have as easy of a time gaining access to capital, and if they do, it's much more expensive. So all of this points to a picture where there is going to be a greater slowdown, if not a recession, probably in the back half of this year. And we can see JOLTs took a turn for the worse. This is data that suggests that the amount of job openings that we're seeing right now are still high. There's still about 1.6 jobs available for every one person who's counted among the insured unemployed. But it also tells us that that's slowing, that some of these jobs on offer are no longer there. And while NFP, or non-farm payrolls, were pretty strong versus what all the other data suggested, it's also telling us that maybe we're starting to see some of that excess tightness in the labor market roll off, which is another sign that could be good for inflation, but also means a slowing economy. We saw ISM manufacturing last week get to 46.3. That was the worst reading since May of 2020. We can all know that back then we were in a pretty brutal economic environment, and this is a pretty nasty reading. This is deep into contraction territory. Now, the good news is manufacturing isn't a huge part of the U.S. economy anymore, but the bad news is it tends to be a leading economic indicator with a fair amount of accuracy that we're going to get into a recessionary period. And this print, once again, suggests that we are heading into a recessionary period. And we can see there's a reasonable correlation between the price of oil and CPI. With oil breaking above $80 a barrel, we may see some of the relief in CPI begin to reverse. We'll also note that gasoline did not apparently get the memo that it was supposed to go down when oil went down to $65 or so a barrel. Gasoline stayed much more resilient. It did not make a new low, and then now it's making a new, more recent high as oil resumes its buoyancy after the supposedly surprise OPEC Plus cuts. Now, this is important because almost everything ties into the price of oil. Agriculture, growing food obviously takes farm equipment that's powered by oil, but there's also fertilizers and pesticides and herbicides and fungicides, which are generally petrochemical in nature. So there's a lot of input there. Then there's the transportation costs. So oil plays a big role in food. It also plays a big role in construction. Imagine the equipment, the materials. There's a lot of involvement of oil and distillates and petrochemicals in other senses. And then look at everything around us, all the plastics that we might use, all of the petrochemical usage in pharmaceuticals. It's just sort of in everything. Oil is a very ubiquitous substance, whether it's directly or indirectly in everything. It has ways of sort of being a part of every component of the economy, whether it's involved in making it, transporting it to where it's going, or otherwise. So I would say that as the price of oil begins to resume this upside, that's a rather bad sign for inflation should it stay sticky, should we see OPEC countries be able to keep the price of oil over $75 a barrel. That's going to keep some of that goods-driven and services-driven inflation higher than what the Fed wants to see. There's a memory crisis going on right now with Samsung, who expects to report as much as a 96% drop in their earnings for the first quarter. And this is because they have a glut of chips. They're having to mark them down to move them. They did not slow their manufacturing when there were all signs that semiconductors were going to start to struggle in terms of the demand for them. And so this has left them in a fairly precarious position. So we're going to have to keep an eye on this and what the implications are for other semiconductors. I think this is a rather bad sign. I think there's a lot of froth in semiconductors right now. I believe that the run in NVIDIA and AMD and some of these other stocks has been quite overdone. SMH ETF as well. It's all suggesting economic expansion. These are cyclicals. These are leading sectors and industries that should not be bid up as much as they are right now. That doesn't mean the market can't remain irrational longer than we can remain solvent, as Keynes said. It can, and it does, and that's what it sometimes does best. But what it does mean is it's likely to become a better and better short opportunity. We also heard from Foxconn last week, which said that their sales to Apple have been slowing, that the growth is just shy of 4%. And that tells us that maybe Apple's iPhone sales are not going to be as impressive as investors may hope for their first quarter earnings. It's going to be something that's very important to keep an eye on. What is the consumer appetite for electronics? Are we starting to see these semiconductor leading indicators permeate into earnings? And if not this quarter, then next quarter. But I would imagine we'll see some signs in the earnings and guidance this quarter of what's happening with this dramatic slowdown across the board in a lot of semiconductor companies. Micron was another, where if we annualize their most recent quarter, it suggests that their revenue has dropped by about 50%. These are all signs that are ominous. It's this type of thing that we are keeping a very close eye on at MacroVisor, because there are opportunities in this, both in terms of longer term investments that will become attractive in time, as well as shorter term opportunities to trade what's happening in the semiconductor industry. There's probably going to be a fair number of short trades, long short trades, sector-driven trades, and regional trades that can come out of this. Speaking of regions, check out Korea's chip exports falling. One of the worst industry downturns that the semiconductor industry has ever seen. Now, consider that in light of all of the pricing that we've seen in semiconductor stocks, and ask yourself if it makes sense, particularly in some of the more extreme examples. There is a big detachment between fundamentals and pricing. And I know some folks will say fundamentals don't matter. When have they mattered? And it's true, for the better part of the last 14 years, they haven't mattered, because there's been an abundance of excess liquidity chasing returns in all the riskiest assets, particularly post-COVID. It will matter again. Fundamentals will matter again. And I think this earnings season that's coming up will open that door. We see Treasury yields rebounded after Friday's non-farm payrolls report, the 2-year Treasury yield rising pretty significantly here. Why is this important? Because it's starting to tell us that we're expecting another Fed hike, about 71.2% probability of a 25 bips hike on the May 3rd FOMC meeting. We're going to get Fed minutes this week on Wednesday, so it'll be very important to take those into consideration moving forward to the next Fed meeting. What was the consensus? It sounds like everyone was on the same page about the last hike, but it does sound like some members were actually pushing for either no hike or 50. So they were all in agreement of the policy that ultimately was voted on, but there was some variance of opinion as to where policy should be going in lieu of both more durable inflationary pressures as well as problems in the regional banking system and potentially the global banking system, with Credit Suisse failing just days before the company may have been bankrupt, according to Swiss regulators. We also see the idea of an imminent Fed pivot continuing to be repriced, and that means it's been pushed off further. The initial idea of a 25 bip cut was for June. Now we're seeing 25 bips cuts as early as July, and getting us down by the end of the year to 4.25% to 4.5%, and then as far as this goes out to about 3 to 3.25%. This is something that goes against what the Fed has said publicly, and in their SEP report dot plot, they're really looking to keep rates around their plateau for the entire year of 2023. This chart, however, suggests that, like other occasions of late, that their tightening will be met with a rapid unraveling of that tightening cycle, of a massive discounting of rates rather quickly. And this has been because typically when the Fed tightens, they break something, and when they break something big enough, they turn about. But during those prior tightening and loosening cycles, one major variable was quite different, and that was inflation. We did not have anything like this level of inflation, so the Fed had every excuse, because inflation would get too low, to come back in and ease and make sure they stimulate the economy and the market. This time, it may be different. Now, we'll obviously have to see. We have seen Powell buckle before. The 2018 tightening tantrum caused him to turn about. There was also a great deal of political pressure at the time. But this is a much different situation. Back then, there were signs that the repo market was locking up. Now we have an abundance of bank reserves being parked in the reverse repo market overnight. It's very night and day versus what we saw back then. In addition, inflation was running too low back in 2018, 2019, and that gave the Fed cover to continue back their long-term, decade-plus pattern of emergency-level monetary stimulus. So we'll have to see how the Fed handles the May meeting. It's less than a month away. As we get more data, I think we'll start to get a better sense as to what the probabilities are, and we'll discuss that more as we get closer. But for now, keep an eye on these shifting expectations. We've had almost 40 percentage points of variance in probabilities for this May hike, whether it's going to happen or not. There was a time where the market was pricing in 50 bips. There was a time when the market was pricing in 0 no change, and now we're back to pricing in 25. And the S&P 500 is not cheap. Now, some folks will say, well, there's 5 to 8 stocks that are making it not cheap, and if you take them out, the S&P 500 is between 20 and 33% those stocks, depending on we're talking about like 5 or 8 stocks. Their valuation matters. Unless you're netting them out of your index investing, their valuation matters. Now, if you're buying individual stocks, I'm sure there's going to be some opportunities to get some stocks that are a little cheaper, but you have to factor for, by and large, risk premiums are very low. You have positive real rates. The investment opportunity on earnings is not very good in an environment where we're in an earnings recession that seems to be worsening. This multiple is where we were in the sense of we're not factoring for the next quarter's earnings yet, right? This is a PE ratio based on looking forward, but not necessarily taking into consideration the amount of slowdown we might see. So I kind of look at this as it's forward-looking, but it's based on historic multiples and projections that may well be completely changed in the next month as we see most of the S&P 500 report. I think this is very expensive. Personally, I think that we have room for PE multiples to go down closer to 12 to 15, depending on how deep the recession is, and that suggests the S&P has quite a bit lower to go before it bottoms. I don't think we're in a new bull market. I would love to see the bear market finally play out so that we can get some generational opportunities. I would love to be bullish. I would love to say it's time to get massively risk on. The rally from October, it's certainly been a great trading opportunity. I don't believe it's been an investment opportunity because I don't believe it's a new bull market. So it's been explainable through flows of liquidity from the Treasury General Account, the People's Bank of China, the Bank of Japan, and also the Fed acting to stabilize some of these other markets. And I talk more about this in this week's Navigating the Markets for TraderAid. So if you haven't checked out TraderAid, I think you would enjoy it. You can get 20% off on me by using the code Mayhem20. So you can sign up for our base plan for as little as $20 a month. You can get 20% off your first month or year, $200 a year. So you already get 2 months free. You add 20% to that, you're getting another 2 months free. It's a pretty good deal. Anywho, check that out if you want to learn a little bit more about what I'm thinking. Next up, we have S&P 500 bull markets by percentage and bear markets by percentage. And this chart tends to suggest that we have a little bit more downside to go. The max drawdown in this bear market was 25%. We're not even close to that now. Remembering full well January's high was just over 4,800 on the S&P 500 index. If we were to see a deeper drawdown, a 50% drawdown would indicate the S&P would be getting to about 2,400. Just as an example, I'm not saying it goes there. I do think it loses 3,000 before we see the bottom here, but I don't think it gets down that low. But who knows? No one knows the future. It could get higher or it could get lower before we see the bottom. It has a lot to do with earnings, the macro situation. It has a lot to do with how this market continues to get support from short-term options, retail traders, and bullish institutional managers, all of whom seem to sort of want to discount the idea that things could get worse before they get better. But I think ultimately that is the path we take. This has been the most aggressive hiking cycle. It's the largest multi-asset bubble in human history. It's the best bull market we've ever seen. And that unwinding where we start to see so much of the liquidity coming out of the system is likely to be problematic for returns in these companies. We also see that an abundance of liquidity and cheap debt tend to support earnings, and the lack thereof tends to undermine earnings. So I just want to leave everyone with a joke. The mantra going into this year was no landing. It's something that we've made fun of, right? If you've looked at Aisha and I's Twitter feeds, we've been making fun of that because it doesn't make any sense. There's always a landing. There's always something when a credit cycle comes to an end, a soft landing or a hard landing, right? Typically, we're advertised the idea of a soft landing, and we get a hard landing. I want to say the last 5 or 6 recessions were advertised as being soft landings by the media, by our central bank, and they ended up being rather hard landings. So I would just say we are still in a situation where we are likely to be heading towards a more economic and financial environment where there's more problems, where there's a higher probability of a recession, a higher probability of a extended bear market. And it's not because I want those things to happen. Quite frankly, I'm a naturally optimistic person. I've also been in these markets since 2005, and I've been a student of the markets going back to some of the crises we saw in the early 1900s. And I would just say that we're not anywhere near what is typically the end of a credit cycle. Caution is warranted. It does not mean we're going to have a crash. It means the probabilities of an extended slowdown are higher. The probabilities of recession and a bear market that continues are higher. And the probability that we see new highs before we see new lows is very low. That's all. I know it's a sobering note, but it's a funny comic. Right? Because what is a no landing? If a plane doesn't land, it's a crash, right? So why are people saying no landing? What are they trying to say? Anyway, just a little fun. So I want to thank you for watching. Be sure to check out macrovisor.com where you can find more of my research and analysis. We have a 50% off your first year launch sale for our premium plans running right now. So basically, from now until the next several weeks, we're going to have a 50% off discount for all of our MacroVisor plans. That's if you sign up for a monthly plan or a yearly plan, you get that 50% off for your first year. That's our launch sale. We're very happy to do it. Aisha and I started this project because we wanted to share more ideas and research on macro without completely saturating Treasury with that content. It's not that we're not going to share it there anymore. We love sharing our ideas and our macro content on Treasury, but Treasury is more about short to intermediate term trading. It's more about teaching about trading and then working in the macro overlay, talking about the fundamentals, but it doesn't all revolve around macro. And MacroVisor is the more academic but accessible and actionable approach. There's much deeper research. It's much more volume of content. And it does come in at a higher price than the Treasury service because there is that extended effort and depth. So we're giving that 50% off discount. Check it out if you'd like. Also check out Treasury.com. I just mentioned it. It's about the short to intermediate term trading time horizons. We teach a lot about not only what we might want to trade, but how we think one should consider trading. We want to help you find your edge so you can cut through the noise and become a more consistent trader. You can get 20% off our already ridiculously cheap plans at Treasury. They start at just $20 a month. Get 20% off any monthly or yearly plan by using the code Mayhem20, Mayhem20. Follow me on Twitter at Mayhem for Markets. That's at Mayhem number 4 Markets. And be sure to like, subscribe, and share. I'll catch you next time.